So, good evening, students. Let us have a lecture on demand for money. Students, you are aware that there is a version called as the Keynesian version as far as the demand for money is concerned. And in the present lecture, we are going to see the Keynesian approach or Keynesian views as far as demand for money is concerned. So, um, at the outset, let me tell you about the concept. Many of us, we need money in our day-to-day life. We use money in our day-to-day life. We try to complete our requirements in the day-to-day life by making use of money. But one should have a very clear-cut theoretical understanding of the demand for money. And so this is an attempt to explain to you Keynesian views or Keynesian approach as far as demand for money is concerned. Friends, at the outset, let me give you the outline of the lecture. There will be a brief introduction in the beginning, followed by some information about a legendary economist, John Maynard Keynes, his contributions, etc. Of course, very briefly. This will be followed by the very foundation of this theory of the demand for money, which is also known as the liquidity preference theory of the demand for money. Then we will see various motives behind holding the money, like transaction motive for holding money, the precautionary motive, and the speculative motive. And then we will see the concept of liquidity trap. And at the end, we will see the total demand for money. So friends, let us start with the introductory aspect. As you see in this slide, we begin our session with the concept of money. What is money? It is defined in a unique way. Money is defined as money is what money does. It sounds very abstract. It sounds very difficult to understand what exactly this definition means. But friends, let us make it simple. When we say, like, money is what money does, it is presumed that money is anything which performs the role of money. And therefore, we need to throw a light on various functions of money. Primarily, money performs 4 different functions, such as it performs the medium of exchange. In a simple words, if you possess money, you can exchange those units of money and you can get the goods and the services in lieu of that exchange. Secondly, it is a measure of value. You can count the value, you can measure the value of particular product, particular good or service in terms of money. Thirdly, it is a standard of deferred payments. Money can be used to make forward payments or future payments. And lastly, store of value. Money can be used to store the value of asset, or you can store the value of asset in terms of money. So friends, these 4 important functions, like medium of exchange, measure of value, standard of deferred payments, and store of value, are four important functions. Therefore, we need money. Now, Keynes, in his views, in his ideas, or in his approach, has focused two important functions of money. The first and the last one, that is, medium of exchange, is more highlighted by Keynes, and store of value is also more highlighted by Keynes. So, we proceed further with the, the information regarding this economist who has given immense contributions in the area of macroeconomics. So, student friends, John Maynard Keynes, known as J.M. Keynes, was born on June 5th, 1883, and he died on April 21, 1946. He was a British economist, not only economist, journalist, financier, and his contributions in the world of economics are very valuable. His theories are famously known as Keynesian economics. The major area on which he worked is unemployment and money. So, the book which came in the years 1935-1936, shortly called as a general theory, but the actual title of that book is the General Theory of Employment, Interest, and Money, advocates various measures which can be undertaken, particularly the fiscal measures. I mean to say, from the government side, measures related to the expenditure, measures related to the taxation, which can be used in order to reduce the impact of recession and in order to create more jobs, thereby reducing unemployment. So his contributions in the world of economics are very, very valuable, and seems to be a torch-bearing economist whose views have overruled the thinking in economics for last 6 or 7 decades. Moving forward, coming to the foundation of this very particular theory of the demand for money, also known as the liquidity preference theory of the money. Friends, we need to understand, why is money demanded? Why do we need money? Simply, you will say, to buy goods. You're correct. So first thing we have to understand, answers to these three very important questions. Why money is demanded? There must be some reason, otherwise why we will hold money? Secondly, why people prefer the liquidity? Liquidity is nothing but money in the form of cash and coins, paper currency, as well as metal coins. And third important question, what are the determinants of the demand for money? So friends, it is very unique to answer these three questions. Why money is demanded? You will say to buy goods. Why people prefer liquidity? You can say to meet their challenges or to meet their requirements. And what are the determinants of the demand for money? One may demand more money, one may demand not that much money, or little less of that. But when you go to the deeper insights or understanding of the foundation of the theory, you will find that human being always suffers from two emotions. One is fear, fear of uncertainty. Man has got a fear in his mind that what might happen tomorrow, and so he tries to keep money in form of cash, money in form of coins, so that he may meet any challenge if it comes tomorrow, day after tomorrow, next week, next month, next year, so on and so forth. So friends, that fear, that anxiety that curiosity, that uncertainty is at the root why people demand money. So if you don't have money, you suffer from fear, you suffer from uncertainty, you suffer from uneasiness, you suffer from anxiety. Contrary to this, if you possess money, then you feel confident. That gives you courage. That gives you the bold feeling. And therefore, people demand money. We have to put this in a theoretical framework, considering these three questions. Number one, why is money demanded? Second, why people prefer liquidity? And third, what are the determinants of money? So fear and uncertainty on one side when there is no money, and courage, confidence, and bold feeling on the another side when you possess money can give us a roadmap where we can understand how money is demanded. So moving forward, we need to understand that that demand for money is basically with some motives, with some purposes, and therefore those needs, those motives, those purposes we will be understanding in a very clear cut manner. Moving forward, for we can see that the demand for money is basically determined, is basically ruled with certain motives. Now, what are these motives? And let us try to understand these motives again in a very clear cut and precise manner. As I told you in the introductory aspect, that the demand for money lays questions like why people demand money, okay? What are the determinants of the demand for money? And then we have seen the the causes for the demand for money. Moving forward, friends, it should be very, very clear that there are three very precise and very clear motives. One is called as a transaction motive, second is called as a precautionary motive, and third is known as a speculative motive or speculation, you can say. And in the next 5 or 10 minutes, we are going to focus more light on these three important motives. Transaction motive, which is further divided into two sub-motives, we can say. One is income motive and second is a business motive. What is transaction motive? In order to lead our life in a meaningful manner, we need to buy many goods and services so that we can satisfy our wants. And to do that, we possess money, we need money. So friends, it is very clear as far as transaction motive is concerned, in order to meet our day-to-day requirements, we need to keep some cash at home. We need to keep some money in the liquid form at home. But you're aware that people receive income at different intervals. Some people receive usually income once in a month. If you're a salaried person, say you may get a salary in the first week of a month, and then next month, then next month. So the income interval is 1 month. Whereas some people may receive weekly wages, some may receive daily wages, for example, in case of daily wage earners. So suppose you receive your salary on 1st of every month, then you will have to keep like that money with you till 30th or 31st of that month, because receipt of income will be once in the month, but expenditure will be every day. And to meet those needs, meet those expenses per wants, you need to keep some cash at home. So that is called as transaction motive behind the demand for money. Now, income motive explains us like people receive income once in the month, okay, but they have to spend money every day. So money held for this purpose, that is to make payment for the day-to-day requirements, declines over the income interval period, and therefore demand for money will be very high in the beginning of say a month, and at the end of the month there will be very less demand for money for transaction purpose. Try to understand this point. The second motive is the business motive. In case of businesses, many entrepreneurs also need cash, also need liquid money in order to meet various expenses in a day-to-day transactions, such as to pay electricity bills, to settle the rent, to buy raw material, to pay wages, etc. And sometimes these entrepreneurs, they may receive income once in a month, once in 2 months, once in a quarter. So there is big time interval also. And in that case, they don't know when they're going to receive the next installment of income. And so they will hold money in the form of liquidity with them. That is the motive which is known as a business motive. Friends, there are two more motives. One is a precautionary motive. We'll have to see that little later. And then we'll have to see the speculation motive. Moving forward, there are certain important determinants of the transaction demand for money. Transaction demand for money is basically determined by the level of income. There may be, say, two persons, person A with high level of income and person B with low level of income. Naturally, the person having high level of income will have high requirements, high wants, more number of wants, more number of needs, we can say. And in order to buy those many large number of goods, large number of services, he needs to possess a lot of money in his home or in his bank account. So higher the level of income, more will be the transaction demand for money, and vice versa. As I told you, a rich person may demand more money than poor person. Poor person obviously may be trying to meet both ends, and his needs may be very less in numbers, perhaps food, clothing, and shelter. So he will demand only that much money which is required to meet both the ends or to satisfy his basic requirements. Second determinant is a time interval. If person receives money with more frequency, suppose person receives income daily, then he will demand less of money. His preference for liquidity for the transaction purpose will be less. Whereas a person receiving income once in a month, his demand for money for the transaction purpose will be more in the beginning of that time interval or time period when he is receiving money. Third, the price level. Price level determines the inflation in your economy. So friends, that is also very important determinant, because During the inflationary period, transaction demand for money remains high because prices keep on increasing. So more inflation, which simply means you have to pay more for the same basket of goods. And during the inflationary period, what happens? You have to keep more money at hand or in home. So that even if the prices are going up, you will be able to pay for that basket of goods. And lastly, the volume of employment. Employment determines the capacity of earning. And therefore, friends, when the level of employment in the economy is high, more jobs are created, more hands are employed, and therefore more output is created, more production is undertaken, and therefore more people are employed, more income will be generated, and there will be more demand for transaction money or more demand for transaction money. So four important determinants we have to understand and keep in mind. One is the level of income, second is the time interval, third is the price level, and fourth is the volume of employment. Quickly have a relook. This is a very important stuff. Higher the level of income, more the demand for money. Okay, more the frequency of receiving income, less is the demand for money. I mean, I'm talking about transaction demand for money. Higher the price level, more is the demand for the transaction money. And then lastly, higher the employment, more will be the demand for transaction money. Moving forward, we need to understand the second very important motive behind the demand for money, and that is precautionary motive. Friends, life is full of uncertainties. God knows what is going to happen tomorrow. So we are always living in the era of uncertainty. Philosophers says that uncertainty is the only certainty. Life may face various challenges and life is full of contingencies. We might need to spend money on sudden expenditures. Also, uncertainties might pose or throw various unforeseen opportunities to us. Challenges like illness, challenges like unwanted accidents, emergencies, etc., or people losing jobs, and that temporary unemployment can lead to fall in the level of income. So in such case of uncertainties, one need to hold on cash, one need to possess cash so that you can meet those challenges, you can face those challenges successfully, and therefore there is a demand for money which is known as the precautionary demand for money, or the demand for money with precaution as a motive behind that. One needs and one believes in maintaining the existing standard of living, and you will be able to do so if you possess money in good quantum today, so that tomorrow's challenges can be accepted and can be faced, and you can meet those challenges successfully. So that motive, or the money demanded with that motive, is known as a precautionary motive. So let us have at the end a graphical representation which will help us to understand how exactly these two motives rule the demand for money. Friends, try to understand. I have spoken about two motives. Number one, it is a transaction motive, and second, a precautionary motive. So I will call transaction motive plus precautionary motive, that is LT plus LP, as L1. And friends, this L1 is a function of level of income. In this graphical presentation, you can see on y-axis we have taken money income of a person, whereas on x-axis, on horizontal axis, we have taken transaction demand for money and precautionary demand for money. And there is a straight direct relationship between these two, which is explained with this upward arrow or upward line, indicating that as the money income of the person increases, like this, his transaction demand for money and precaution demand for money also increases, and vice versa. So, friends, what we have done today is we have tried to understand a part of Keynesian theory on the demand for money. We have tried to understand the two important motives behind the behind the Keynesian theory for the demand for money. One is the transaction demand for money, and second is a precautionary demand for money. We will continue with this in our next video for the speculation motive. Thank you for patient listening.